Well, hello, friends. Welcome back, everybody. Episode 98.
Ooh,
We're getting there. 3 digits nearly.
century mark.
You know, what I just realized is I get to write the 100th episode.
Oh, lucky
nice.
you. One of
Well, it
the
should be.
originals. And yeah,
was
yeah.
the OG.
Yep.
Pretty good.
That's pretty fitting.
Pretty good timing.
So for all of our listeners, get ready. We for sure have something fun planned for.
Maybe I'll have to start writing it now instead of
Yeah.
5
3
o'clock
minutes
the night
before.
Yeah. Other than that, the usual crew is there. Keith, Tyler, and Lisa is in a hosting seat this week again.
Oh, should be a good show then.
Let's start traditionally with our two truths and a lie. And I brought a little bit of something different today, and I hope we get to that. That's part of the fun stuff at the end. It's Metaverse. I mean, it's nearly put to the dead. So, but we heard
Is that still around?
It's still around. Yeah, that's a surprise. We still heard a little bit about that lately. So I thought, you know what? Let's get a two truths and a lie going with that. So the metaverse economy includes virtual real estate, digital goods, and services. B, user adoption of the metaverse is comparable to social media platforms. Or C, digital ownership in the metaverse is often enabled by blockchain-based assets like NFTs. Keith looks
Puzzled? Yeah.
yeah. Let's start with you.
Thanks, Lisa. Let's work down the list here. The metaverse economy, yeah, that sounds reasonable. Real estate, digital goods, services. User adoption, the metaverse, comparable to social media. My guess that's kind of where the trick lies. So I'm going to say that's actually true, though. And then the blockchain assets like NFTs, I think that's where the problem is. So I'm saying C is not true.
Okay.
Just quick, succinct.
Quick, I didn't put a whole lot of numbers in it this time.
No,
so
I saw you when you were creating this. You had to jump over your screen. To make sure
I had to hide it from you because you sneaked. And I created my evil quiz. Tyler, what about you?
B.
Whoa! Just
okay.
confident.
That's okay. That's confidence.
Either that, or is like he's taking the high school test where he's just like doesn't have any clue. And he's just going
for
B.
Yeah.
Well, no, I mean the metaverse, the economy. I mean that's what it's essentially used for is virtual real estate, digital goods, and services.
Mm-hmm.
Digital ownership in the metaverse is often enabled by blockchain assets. Yes, that is true. Because metaverse is backed by blockchain. And then when you buy real estate property, you basically get like an NFT that shows that you have ownership.
Oh, that's for the NFT part.
Yeah. Right. And user adoption for metaverse comparable to social media platforms. Like it depends on if we're talking like MySpace, like back in the day. Probably. But
nitpicking again, like general, like Instagram, TikTok, like general, like the big ones, the big boys.
When you think of like Threads, I think Threads was at like 1 billion users in what, like 2 weeks?
Not
Metaverse,
even, yeah. It was
Metaverse certainly did not take off like that. So
yeah, I have to say Tyler is right.
Yeah, that's where your trick was. That was like the most obvious one. That's why I figured that you were gonna.
Yeah, and I was like, okay, that's an easy one, but I kind of reshuffled the words a little bit that it's not that obvious. So user adoption of the metaverse is nowhere near like Instagram or Facebook.
How many people you think are? Is there an official metaverse? Is it like 10?
Is there like a projection of actual users? Not really.
It's kind of metaverse kind of died off.
It's kind of out there still, but more on that later.
Well, it's funny. Facebook to metaverse and also the metaverse. It's not.
That was the huge thing, right? I mean, Meta even changed the name of the company to that. So yeah. Anyways, I want to talk a little bit about something that I heard a couple of advisors clients asking. That is might be a little bit counterintuitive for the situation that we are currently in with the Middle East conflict and war in Iran, that the safe havens aren't really safe havening at the moment, right? And what I mean by that is like gold, for example, the ultimate safe haven asset. You know, when something hits the fan, everyone is flocking into gold. Gold is kind of keeping us a little bit stable in times of uncertainty, as well as bonds, fixed income, general treasuries also should do the trick there. And what we saw since the conflict began end of February, both assets are not really fulfilling that prophecy at the moment. So yeah, why isn't that playbook working this time as expected, or why is safe haven assets not really safe havening at the moment? I want to start with gold, which is down 14.5% since February 27th and down 20%, so officially in a bear market since its recent high in January, which a lot of people are surprised by that it's not only down, but it's down meaningfully. Silver the same, a little bit more aggressive, but kind of in the same ballpark. So what's going on, Keith? Let's start with you.
Yeah, I'll start with the gold. I'm sure I'll leave the treasuries to the
I thought so. We put that over there.
Part of it, I think, is which we talked on here many times. I think when I've talked to advisors over the last year, I think gold we're getting in the later innings, and just kind of baseball analogy, or when it was peaking above, what was it, got to 53, 55. Yeah. I think you're just getting late innings, and it is a massive performer for 2 years. It's just looking just like any other asset class. They look for reasons to sell off. I think part of it was just extended gold. Yes, it is a safe haven, but it had such a massive performance. I think people are just taking profits there. And then on top of that, the dollar got a little bit stronger here recently. I think that was the trade-off, right? U.S. dollars coming to an end. We have to get,
Can you maybe explain a little bit for our listeners, Keith, why when the U.S. dollar is stronger, which was one part because it was weaker last year, why gold took off, what the relationship is between a stronger U.S. dollar and why gold is doing
you get
weaker when the dollar is stronger?
Yeah, when the dollar does better, there's some governments, foreign governments, that have been buying gold, right? The end of the U.S. dollar, basically, they want hard assets versus using U.S. currency to buy things. Like now, I don't know if we'll touch on it with oil, right? Example is, oil is generally traded in dollars, but obviously the countries that don't like the U.S. don't necessarily want to trade in dollars, and gold is really not realistic, so they want to use a different foreign currency. But I think that's where the replacement is. So when the dollar does better, then there's probably less fear out there that's the opposite for the gold. Gold trade is, everything's going to, like you said, bad. The U.S. dollar is going to be horrible in the longer term. So let's get a hard asset, gold. So that's when the dollar starts firming up, the opposite should be true, right? It should be have a less of a need to hold those gold assets.
Yeah. Tyler, any other reasons why gold is not? I mean, we heard it's extended. It's quite its spot. Like last year was the best performing asset class out there. The U.S. dollar connection to generally how gold is doing. Any other reasons you think that gold took a little bit of a backseat at the moment?
Well, to Keith's point, you've seen multi-decade highs in gold purchases from central banks around the world. And a lot of those central banks are not the U.S. central bank. It's BRICS countries. So Brazil, China, Russia, India, South Africa, and then a cohort of other emerging economies that have recently joined. I think there's 26 countries in BRICS now.
That many?
Yeah.
That's interesting.
So you've had that dry up a little bit, which has always been the last 3 years has been a good base for gold to perform. Not that they're buying enough to push the price of gold higher, but then you get the influx of retail investors that you've seen lately, of flows into different ETFs that are physically backed by gold. And so I think it's more of a positioning at this point of just, gold historically does not perform as well as it has the last 3 years. So I think it's more of just like he said, just a trade at this point, and
not really fundamentals at this point.
Yeah. Gold wasn't trading on anything fundamental really the last 2 years anyways.
Yeah, that's how I would flip it on.
Yes, you got U.S. dollars down 15% last year, so you get a tailwind for that along with international equities. But generally speaking, if the dollar is going to be stable, you're probably not going to see the type of performance that you've seen, and then the inflows just kind of dry up a little bit.
Yeah, you won't see that 50% move, or silver last year was it 100%?
Yeah, so 100%. Yeah, you don't see that this year, but gold can still perform well for the rest of the year, I think. Central banks are still buying, but a little bit on the backseat at the moment. A lot of these BRICS countries are heavily reliant on Middle East oil, So it said, okay, some of them had to sell some of their gold reserves in order to for higher energy purchases. But it's also interesting because what we see with gold here at the moment, it seems like, oh my God, it always has worked in the past when geopolitical stuff really got bad, that gold was an outperformer. But when you actually look at, for example, 2008, 2020, 2022, all different reasons, but all different shocks. And when you look at the gold price there, and there's a similar pattern, it sold off initially on news, on headlines, on kind of investors selling out of gold in favor of the US dollar. But these periods were usually followed by strong rallies in gold. So
dude, here, put you on the spot. Do you think for the rest of the year, we're end of Q1 here almost, between now and year end, do you think gold up, down, flat, and does it do better than the overall market, the S&P 500?
So I think we will be up. I think we will kind of figure out some way of normalization there as well. We will sure not see another year like last year. So I'm pretty sure about that. That was very decades long high, like Tyler said. It was very unusual, also for silver especially. But I think we are up. Gold will still perform well. Better than the overall market? That's the question. I don't know. I would say, what, just to get a brave prediction out there, I would say yes, it will beat the market this year.
Tyler?
Well, one thing that people often forget too is precious metals are actually very volatile.
For sure.
Right? Like traditionally, you go buy an ounce of gold and you put it in your safety deposit box at the bank. You don't really think about it until 5-10 years down the road. And all of a sudden you're like, oh, now it's up 100% over the last 10 years. But on a daily basis, when you're owning the physical asset and seeing it trade on a daily basis, you do get these big price fluctuations, and people often forget how volatile they are.
Yeah.
With that being said, I do think gold performs fine this year. I don't think I think you at some point you will get a decent rally here off these lows, but you're going to need to see central banks come back in, the rhetoric around BRICS pick up again. And I think the war in the Middle East right now is more about oil, and people are more focused on that than actually like global issues. If it starts to spread out and you start to have like Russia, China, like more of these bigger GDP economies get brought into it, then I think you start to focus more on gold, and gold sees a bigger rally. But for the time being, it's still localized to the Middle East with just a few countries. So I think it performs fine. I don't, if we can claw back the loss that we've had this year so far, I think we've finished flat to slightly up at best.
Okay, slight to flatly up. I would say up, potentially beating the market. Keith, what's your prediction?
I think it kind of just goes sideways from here.
Okay.
So to year end, I think it'd be a laggard relative to the market. I'm still constructive on the market. Again, price of oil, which we talked about a lot, is very fluid situation. I think fundamentals are still good. So I prefer the stock market. And that's kind of the question we get from advisors. Where are we at? Should we make this allocation decision? So I would say, yeah, if you're in gold, it's probably fine. I personally prefer other things right now than gold, even on this pullback. I think it was just a massive performance to Tyler's point of a couple years of performance. Then you can go 3, 5, 10 years where gold doesn't do anything in the market. Generally, goes up, but then all of a sudden you'll have a period like you had last several years where gold is massive outperformer, and then I think that's where towards that tail end of that.
Yeah.
Well, when did gold? Was that back in early 2000s, where you just saw this lull, and then finally, like it was this big.
It didn't go anywhere
to your technicals of the cup and handle kind of chart. That's kind of like what it looks like on a
longer term
25-year chart.
And then when it broke out, that's what everybody got excited about, right? And that's part of this. I'd say we're in this later innings. Not that gold has. I don't think it's from these levels. It's okay,
but it's not a massive outperformance.
No, I prefer the market at this level.
Okay, and then let's move to the next safe haven asset out there: fixed income treasuries. So Tyler, as your resident fixed income specialist here. I mean, since February 27, since the start of the conflict, the 10-year Treasury is climbing 45 bips to 4.39. The 30-year rising 33 bips to 4.96. 2 years up sharply as well. That's in a risk-off period, basically.
Yeah.
What we are seeing, which is very unusual, right? So can you explain a little bit why you see that at the moment?
Well, longer term rates are pushed by the market. Shorter term rates are more pushed by the Fed and what they're doing on their interest rates. So we key off of the 10-year Treasury is typically like what you're looking at on what's going to affect bond prices and where interest rates are going to be going, generally speaking. And so the 10-year takes into account your term premium. It takes into account the potential for GDP growth, future GDP growth, and inflation, and then also the willingness of investors to trust that the U.S. government is going to pay back their debt. So obviously, with everything going on with oil and the potential impact that could have on not only headline inflation for the energy prices, but also all of the goods that consume oil, that oil is a part of the product. And so we're actually starting to see the market is starting to price in actually a rate hike this year.
Tyler, what did you say? A rate hike?
Yeah.
Last week there were whispers, right? We were talking about, oh my God, we hear whispers in the market of potential rate hike. Now there is at least 0 cuts priced in, and now it's getting a little bit more.
It is pricing in one full cut by I think October.
For Europe, it's pricing in 3 full raises for the European Central Bank.
Yeah, because they're a little more tied.
They have a little bit more issues with high energy prices than the U.S. But even there, it's kind of everywhere. Yeah.
But that's to our point that we talked about last week of like, does the Fed actually do anything based on oil prices? But now you start to get this extended period of elevated oil, and it leads into all the different goods and potentially leads to inflation, which the Fed is focused on overall inflation. And so now we're starting to see them potentially price in a rate hike. And so what that means is there's concerns over the future of inflation. So the 10-year Treasury is starting to rise. There's also some uncertainty on if the U.S. does continue this war and all the defense spending that we're going to have. There's going to be more debt to be had. And then investors want a higher risk term premium for investing in a 10-year Treasury because, you know, the uncertainty of in 10 years, are we actually going to pay back the bond? So they want a higher yield on their bond. So there's that inverse relationship between prices and bond yields. So when yields go up, bond prices go down, which is what we're seeing right now, which is why the safe haven of bonds isn't really the safe haven that people expect it to be.
And that's also when we talk a little bit about duration, for example, of 7 years in a bond portfolio, why they see some sharper price swings, right? Because like a 1% move for every yield change can lead to pretty steep price swings here. So what are you suggesting at the moment? Going shorter or longer on the duration, or what are we doing here?
The Fed also had their meeting last week, and they released their SEP, Summary of Economic Projections, and they actually raised their long-term Fed funds rate from 3% to 3.1%. Not a big move, but when you look at the historical spread on a yield curve, it's about 1.2%. The 10-year Treasury is about 1.2% above the yield of the Fed funds rate. So 3.1 plus 1.2 gets you to about 4.3. We're sitting a little bit above that. Obviously, there's a lot of stuff going on. So I don't think there is some risk to potentially test that 5% again, which means you'd want to go shorter on the duration. But I don't think I think there's less concern right now of getting to that 5%. But if this war continues and there's higher inflation expectations, I think you could see it test the 5 potentially, depending on how long this goes.
Do you think you hit 5 or 3? That's what, 3.75? Which one do you think is more likely?
I think there's more risk to 5 at this point than going back down to 3.75.
Stable value it is, it seems.
So yeah, I mean, shorter durations like the fixed income total return, the idea would be you shorten we're already like in that portfolio. I don't like investment grade credit. I think it's just
not getting enough.
Too rich.
Yeah.
So we're already extremely short. We only have 5% allocated there, and it's already in the short, like 1 to 5 years. And most of the duration that we're taking is in the treasuries. So what you would want to do is shorten up the duration on the treasury side for the fixed income total return. If you're wanting to make a full portfolio change, then, laddered income 2-year, 3-year, or stable value would be kind of the play that you'd want to go.
Mm-hmm.
Yeah.
Depending on how tactical you want to be.
No, I think, interest rates, ultimately, I think Tyler laid it out well, what's going on, what the market expectations are. So then us as portfolio managers and kind of strategists, what do we have to change on our portfolios? I think it's stay the course. I mean, obviously we can be a little bit flexible within these portfolios we're talking about, but I think we're in that 370, even maybe a little higher, 380, 85 to 450. It's kind of the range that it feels like we're in. So it's, which for a person that's in retirement, it's not the worst thing. There's always a double-edged sword, right? The reason that the market investors like the Fed cutting rates is generally that spurs growth, economic activity. That's great, right? And especially as the U.S. consumers, they love to borrow. So generally you're borrowing at less interest rates. I mean, not always, but generally if the Fed's cutting, that's the word, the interest rate curve goes down. That being said, the people that are in retirement that have some assets, they prefer to have rates a little bit higher because then they earn a little bit more risk-free. Again, that's the whole, we can debate that at a different time of.
Depends on how you're investing in bonds, right? Like if you're investing in the ETF bond portfolios, you're kind of, your play is always, you don't have a bond, there's lots of bonds in there that mature, but they're not constantly rolling. And so you're always fluctuating. Whereas like if you buy an individual bond, you don't necessarily need to worry about where interest rates are going if you're
clipping your coupon.
Yeah, and you know that you're going to hold it to maturity. So.
Yeah, no, but I mean, to ultimately your question of gold and treasuries, I think that's why. I think the short answer to why treasuries have been backing up is the fear that the Fed is no longer in the cutting phase, and then they're into the doing nothing phase to potentially hike. I don't think we're in that potentially hiking. I'm firmly in the camp of do nothing. But the reason they're do nothing is because oil prices have risen, which causes potential inflation to be more sticky, because that oil prices is, I said, months ago, it was kind of a hidden tailwind for the markets. And now that was at 60, 65, and now at 90 plus, that I got to change my mindset as well. If it stays this high, I don't think it does. But that being said, every day that goes by, every week that goes by in the 90s to 100, that's certainly a headwind. It goes from that slight tailwind to a slight headwind or a bigger headwind that goes through the economy. And that's what, the FOMC at the Fed meeting last week, basically, my take was they basically threw their hands up in the air like, we don't know what's going on here.
Which is interesting because the remarks, Chair Powell even said, we don't know what
this
economic
is
impacts
supposed to have
that
the guys that have all the data, the gurus of the gurus.
And they don't even know.
And they don't know. So it's a little bit, that's why, again, when we talk to our advisors and clients, it's have a well-diversified plan. No one, if anybody tells you they know exactly what's going on, certainly not true. But I think inflation is into a little more sticky, which doesn't mean that we're going to above 3, 3.5, 4, but maybe it doesn't get down to 2 where the Fed wants it. And I think that's going into this interest rate discussion we're having here and where we're at, which then increases costs a little bit for consumers. So that I think they're a little bit more on there. But then we have a lot of the tax bills coming through right now, and haven't heard much about that lately. So hopefully that's.
But we also got PPI, Producer Price Index, last week, and we saw
a creep up there.
Yeah, which is always there's like a 2 to 3 month lag between what you see in the PPI versus what you end up seeing in the CPI, which is the consumer side. Producers like the manufacturing and the cost of the products for the companies. And then CPI is what gets passed to the consumers. And there's usually like a 2 to 3 month lag there. So the concern is that you are seeing the impact of not only on shipping and trade, but also on oil prices and those starting to flow through.
Let's not forget about the old tariffs there, kind of who knows what's going on there. Right, we don't want to go down that road.
Oh my God.
That's another whole, that impacts all the stuff we're talking about. Though.
And after the Supreme Court decision, it went irrequired around that because there was so many other things, but it's still
but still a real issue.
It's still around. And also with the with the Fed to get us back to gold, maybe to make the connection there less probability for a Fed rate cut also impacts gold, right? Because obviously gold is competing as a non-yielding asset class with bonds that are yielding us something. So the lower the interest rates, the better for gold it is.
Sure.
Less probability for a cut is obviously also a headwind for gold. So maybe that can be also another reason for its performance lately. Yeah, so let's talk also a little bit about so we talked about gold and bonds in particular, but when we talk a little bit about the market itself, stocks and equities, like that, when we look at historic charts, when we just look at it from the angle of geopolitical conflicts, and we look at past conflicts, how the market reacted and where we are at the moment, a little over 3 weeks into the conflict, then it suggests that we are basically near the bottom and we can see a rebound quite soon. The question that I have though is we have so much going on, like for example, tariffs, right? That is on the back burner again after the Supreme Court decision, but still there. No one talks about it because there's so much else going on. But that is still there, headwind for companies and their supply chain, and all of that. Then we heard like AI, the jitters there, specifically around software, finance, all of that. And we heard private credit, right? Which we hear more now with redemptions and all of that, which hurt financials and the big alternative asset managers. So do you think we are near the bottom now and we can see a rebound, or do you think there's just too much going on out there outside of the conflict and war itself, just in addition to that, just too much going on that you think we will slump around a little while? And just to get some more data, I mean, the S&P is down about 7.5% from its highs in January and down about 4% for the year, which is interesting because despite what we all hear in headlines and everything that's going on, it's a meaningful pullback, but it's not as dramatic as it would suggest, right? I mean, a 4% year-to-date drawdown and 7.5% from its high. I mean, we kind of see that every year at some point in the year. Yes, it's the highest since the last year tariff disruptions in April, but it's nothing too much out of the ordinary. So, Keith, I'll start with you after I meandered a lot.
Yeah, you had a lot there.
lot to say. What is your take on this?
So I'll give you the crystal ball prediction of what I see and kind of, if we look at the last, there's a chart out there basically saying typically after 15, kind of 18 days of all these geopolitical events, that's kind of your downdraft. And after that, then kind of markets normalize and then kind of do their normal thing over long periods of time. I think the pattern probably is going to hold relatively true. I think so. Are we bottoming? I don't know if we're at the bottom, but I do think that we'll see markets are getting oversold too. To Tyler alluded to, I like to use technicals as well. So that's kind of markets are oversold. That means generally when you get overbought, there's a sell-off coming for whatever reason. When markets are oversold, that means they generally bounce. I think we're in that potentially getting a general bounce. And I don't think like this is, I would like to say, pound the table, say this is a bottom. Markets are just going to, go up 30% from here. But I do think we get a nice bounce to get back into positive territory. To you alluded to, we're down 7.5% from highs, down 4% roughly. The S&P, that is, S&P year to date, where I think you can get back into positive territory, then maybe kind of, who knows, doesn't stuff. And then by year end, I think we're still at a very nice place on the positive side. But we're in this, the 7.5% drawdown is very normal, but with all these headlines, it feels way worse, and you're getting more calls than we probably should at this kind of a normal pullback after 3 years of 26, 25, 18%. I'm like, you're off.
We are due for
off those big numbers. It shouldn't be unrealistic. But that being said, all these concerns, again, in doing it 30 some years, there's always concerns, but this year seems to be stacking up more. Media's more
out there
in front of people and constantly in your face. That makes people feel even more uneasy. So that's why, again, I think it's very important to be working with an advisor to stick to your plan, because this is, I think, noise at the end of the day. So,
and if you're, adequately diversified, what we talk about a lot, and maybe have some structured notes to kind of get us some help against volatility and all of that, then probably the investor is not even down 4% for the year.
Yeah, more likely than not.
Right? More likely than not. That's just like 100% equities, right? Around 100% the US. Usually if investors are diversified somehow, that could be even less than that. So interestingly, despite what we all hear, which stacks up, it's not as bad as it would sound.
Yeah.
Tyler, yeah. Go ahead. No, go ahead.
I was just gonna say, I think the market actually pulls back a little bit more from here. I think we test that because a correction is 10%, bear market is 20%. I think we test that correction to see where the market feels comfortable with. But the other thing too is we've talked about it in the past, where would you like to?
Yeah, please. Thank you. Sorry.
Lisa's running the show here behind the scenes. That's why Tyler's
I didn't want to distract him too much, but I was always
so I do think we test that 10% level, but we've talked about it in the past here on the show is there's a lot more sophistication from the retail side, and you always hear about buy the dip. So I do think at that like 10% threshold, I do think you start to see some money flow in and maybe get a little base of what the market is doing. So
yeah.
And also when we look at the market on a PEG ratio, which is the PE ratio, but divided by the actual expected growth rate going forward, so that it's not static, but give us a little bit more future looking. Then we see that, interestingly, in the chart here, our listeners cannot see that, but I found that very interesting, that the most expensive names on a PEG ratio are the usual defensive sectors at the moment, which is healthcare, staples, utilities, while the cyclicals, when we talk about tech and industrials, discretionary, all of that, that sounds or looks cheaper on a PEG ratio by now, which is interesting. So question here is, does that mean the market is positioned, to Tyler's point, for a little bit more sell-off here? Or are we seeing some opportunities that are coming up?
Well, I think this chart's a little bit misleading because, I mean, your Utes and your staples are always going to have a higher PEG ratio just because their growth rates are in that lower. 2 to 8%. Like same with utilities, you're going to get some utilities do like 4%. Some do the median utilities probably around that 6 to 7% EPS growth, but they're always expensive because they are defensive. And so they're typically trading at that 22, 23 times, even on the consumer staple side too, because they are the defensive. They're the
recurring revenue,
cash cows, the dividend payers that people want to be in. And so that inherently, structurally, they're probably always going to have a higher PEG ratio versus like your cyclicals that people don't want to pay a higher valuation for.
Keith, what are you looking at the moment?
Yeah, no, I think your thesis is generally right. I think those more defensive names are becoming, Tyler's right as well, but I do think they're becoming unusually more expensive for the growth they're providing. So I'm looking for new ideas, probably on the other end of the spectrum, comm services. Some of these names I'm already own positions in these kind of things. Technology, I've talked over the last several. When I talk in technology, generally speaking, I own less than kind of what my competitive universe looks like, which has been a decent spot to be in, especially at that software angle. But I think now you're getting to a point where that's probably a good area that if the growth rates hold up, the valuations are becoming really interesting. That I think that's a potential area that we need to be exploring and looking for different ideas. Again, these are just, it's bottoms up stock analysis. So you're not making a whole shift like I'm going to go buy a ton of that and sell some other stuff. But I do think the market opportunity, if we're getting closer to whether it's another couple % down or kind of a bottoming phase, you kind of want to look for some of those names that could do better on a bounce. Industrials is kind of the one sector I think is kind of very interesting to me right now. It's kind of, but that's fair valuation.
Anything else to add on that, Tyler?
Nope.
Okay, perfect. Because we used it in the Two Truths and a Lie, we have to touch on that now and the fun stuff, like the metaverse, right? And we teased it in the beginning, kind of, is it still around? I did not know that. Is it that yet or not? So interesting why I brought it up, because so overall, Meta sits at about 80 billion losses so far, just for this metaverse endeavor. It's one of tech's most significant flop in recent history, together with a couple of others, but that's probably the most advertised or was the most promising one that kind of flopped. And Meta announced I think last week, that it will pull the plug on a lot of these applications, Horizon World, for example, only to kind of make a sharp U-turn, I think a day after, to say, oh, no, actually, we kind of leave it and not pulling the plug on that. So I don't know what's going on there. They obviously cannot agree on that, or cannot put it to the dead completely. But the question is, does anybody care at this point if they shut it down or not? Is actually somebody using that? Are you using that, or have you used that in the past? Like, what is this about? Like, do we actually care? Does anybody care?
I'm certainly in the wrong demographic, but like I certainly don't care, and I didn't know they were shutting it down and not shutting it down.
Right.
So it's like no one pays attention. I'm more
Yeah.
curious of, do you know how many people are actually on it or in it? Is there anybody that I mean?
But there is no stats either, right? Do
No,
you
not
know a little
really.
bit more insights?
Meta
of-
doesn't really talk about it because it
Yeah.
is just a
No, it's like been a
loss.
black
because it's
hole.
80 billion
Yeah.
losses. It's
That's
like,
why.
yeah,
And then people
right.
do quite. Investors are getting
Yeah.
a little irritated on it.
Well, a lot of those losses were back. Was that 2022 when I'm blanking on his name? Big investor in Meta, but he kept writing notes.
Yeah, he's the one that.
Why am I
Yeah.
you know who I'm talking
Yeah, no,
about.
he's the one that basically the child $1,000.
Yes.
Yes.
Yeah.
The new
Why am I
$1,000
blanking on
I
his
am
name?
too.
Anyways, but he wrote a bunch of scathing stuff. I think it was back in 2022.
Yep.
And then finally Meta came out and was like, yeah, we're going to cut back on how much we're spending. And then the stock ripped. And
Yep.
so I think from an investor standpoint, you'd be happy to see it go
Shut
away.
I own it, and I'd be happy to see them just
Yeah.
stop
Yeah.
losing money there.
But from
And
like
it's still losing money.
Yeah.
I mean,
yeah.
Yeah.
But from a user standpoint, I'm sure if you're in that world and like you've built your avatars and your home and you bought the real estate,
Yeah.
and you'd probably be a little upset that it goes away, but that's a small fraction of
people. The interesting thing is there's and I looked it up, there's a couple of very weird purchases that happened on the metaverse. What looked kind of promising in the beginning, you could buy like islands and all of that stuff, and early investors actually made a lot of money in that, reselling that real estate kind of. But interestingly enough, what stood out to me, like someone really spent $450,000, so the online equivalent for a real house that you could move into, just to become Snoop Dogg's neighbor in the metaverse 5 years ago. So $450K of real money spent just to buy the property next to Snoop Dogg's metaverse property.
It's like the NFT stuff, right? Like the
Right.
actual application of like NFTs and what you can do with them is fantastic, but the way it was utilized for digital art just kind of flopped.
Yeah,
Yeah.
very much. Anyways, so we don't care at this point.
That's
I
the
think.
bottom line. I don't think anybody else really does either, other than
Right.
that small fraction.
But interestingly, Meta is obviously not on par what they are actually doing, because first they're announcing, okay, we're pulling the plug, then U-turn one day later.
Maybe they need to change their name again.
Yeah, right, probably. But I think they're getting closer now to actually whatever. That's for the metaverse. That's probably the last time we talk about it. Anyways, be back next week, 99th episode before our big show for the 100th. So now the pressure is on Tyler to get out something big.
Don't worry, I'll deliver.
Oh, nice.
Oh,
I like the
we sure you
confidence.
are. So be back next week and like and subscribe. Bye-bye.